There we go. There you go. So whenever you're ready.
All right. Hello and welcome everyone. On behalf of the Nantucket Athenaeum, I am Daniel Griffin, a program coordinator, along with my fellow program coordinator, Janet Forrest. Tonight we have Abby De Molina. She's going to talk to you about reducing your tax burden. She is a financial services professional with international experience in banking, financial services, real estate, and insurance industries. She's currently working with the consumer bank Santander US. Previously, she worked on their finance, marketing, customer experience teams. She has also worked at Citizens Bank and Fidelity Investment in financial roles. And with that, I will give Abby the floor. Abby, thank you. And we are here if you need us.
Okay, great. Thank you, everyone. Hi, great to see you. As Daniel mentioned, we're in week 2. Last time we talked about financial literacy kind of.
Oh, Abby, we lost you. You're muted. Hold on one second. There you go. Oh, yeah. Abby, if you can hear me, you're unmuted. Or sorry, you're muted is what I meant. Let's see. What's going on here? Sit tight, everyone. I wonder if something came up for her because her camera went off too. Sit tight.
We should be with y'all in just a moment.
Let's see. Oh, okay, she logged out, so she should be logging back in momentarily, hopefully.
You can go to the next slide. So our agenda, we're just going to talk about a couple different things. One is we're going to go through a bunch of key terms for taxes, and some of those include these tax accounts. So I'm just going to give you an overview what some of these terms mean. And then the last piece is we're going to talk about some important tax credits and deductions. And I did want to let you guys know that next week we're going to kind of focus on small businesses and some of those because there's a lot of different deductions and things that apply to different businesses or if you're self-employed. And then also we will talk about different tax strategies. So that will be next week. So you can go to the next slide. So these are a bunch of different acronyms that are for the a lot of the different accounts and arrangements. And so an FSA is a flexible spending account. This is for health. There's also the health reimbursement arrangement. There's a health savings account, a medical savings account, an individual retirement account, and then an earned income tax credit. And so I'm going to talk about all of these, but as I mentioned, there's a lot of different acronyms, so it's just helpful to know what these ones mean. You can go to the next one. Also, these two terms are really important when talking about pre and kind of post-tax contributions and distributions. So a contribution is just any amount of money you put into one of these types of accounts, such as a 401k or an HSA. And as I mentioned, a lot of times you hear this term in conjunction with pre-tax or after-tax. And it depends on whether the plan, what kind of plan it is, which it will be, whether it's pre-tax or after-tax. And that is based on the rules from the IRS. Another important kind of subtopic of contribution is to know that there's something called a catch-up contribution. And this is specifically for retirement savings. And it allows people who are 50 plus to make additional an additional contribution to a 401k or an IRA. And it's also important to know with this, usually when thinking about this from a tax standpoint, you can make a catch-up contribution a certain time after the year ends, as long as you hit the time period imposed by the IRS. So I believe for this year, it would be April 15th. So you could still make a catch-up contribution today if you're calculating your taxes and you see that you might want to still be able to lower your burden. So that's just something to keep in mind if you are 50 plus, that kind of catch-up. And then another term is a distribution. It just means that any assets might be dispersed from any of these types of accounts. And usually it's important to note with a distribution, if there is any disbursement of the money and it's prior to the time when you can access it, you usually have to put it back into the same type of account. So if you had a disbursement from an HSA, you usually need to put those funds back into another HSA. Otherwise, you'll lose that tax status. Another important term to know is rollover. There's all sorts of rollovers. You can see there's, for 401k, there's a direct rollover. IRA, you can do trustee to trustee. You can also do a 60-day rollover. These are just different types of ways that you can move retirement funds into an IRA. And you're just moving it from an old employee-sponsored plan into an individual retirement account. And the important thing with this is obviously that you want to preserve your tax-deferred status, so you don't have to pay taxes or early withdrawal penalties, which are usually around 10%. Another important thing to note is you can also do rollovers with some of these health accounts as well. So an Archer MSA, which is the medical savings account, can also be rolled into an HSA. So you can switch from one type to another. As I mentioned, most times you can move the money within the same type, but if it's a similar kind of family, the IRS will let you do that. And specifically for HSAs, these health savings accounts, you're able to move or roll over funds from one HSA to another every 12 months and still keep your tax status. And usually what's important to note with this is you will get a disbursement and it's a check sent to you directly. You then will deposit those funds into the new account. So even though the check goes to you, you can't just spend the money however you want. You have to put it into that type of account, again, in order for you to preserve your tax deferred status. Capital gains, this is really important. It's a tax on the growth in any investments when you as an individual or corporation sell investments. And the capital gains tax, you'll hear it thrown around. This is really long-term capital gains tax. It applies to anything that's held for more than 1 year. Anything that you hold for less than 1 year would be short-term, and that's really just taxes or ordinary income. And for capital gains, the rates, it depends on what your tax bracket is. It could be 0%, it could be up to 20%. So again, that'll depend. And just important to know that if you're selling something, you'll have to pay this type of tax if you've held them for more than 1 year. And then another important concept to know, which kind of goes hand in hand with this, is talking about indexation. And what that means is you're kind of adjusting the payments to go along with the price index and kind of protect from inflation. And so that concept is like, if you think about, 50 years ago, the price of milk was, let's say, I don't even know what it was, maybe 25 cents, and now it's, let's say, $3. So it's just kind of making sure that with those types of investments, that same time period, you're just making sure to keep along that same price index, so that the purchasing power is the same as it would have been at that time. Another term that comes up a lot with taxes is itemizing, and this also goes along with itemizing deductions. So it's any sort of expense that you can take, subtract from your adjusted gross income, AGI, and then consequently reduce your tax bill. So important thing to note here, I have it later in the presentation, but if you are going to itemize deductions, you just need to make sure that if it's $250 or more, that you have some sort of paperwork, receipts. This can get complicated, but there are a lot of really great tools out there to help you. There are different apps and computer programs. There are apps that you can use to take pictures of all your receipts. And some of these apps will even categorize and move the money, move the receipts into different folders so that you have everything organized. So depending on what tool you use, these are great ways for you to kind of keep track of all of your receipts. And this is especially important, and we'll talk about this more next week or next session with, small businesses, or if you're self-employed, where you just need to be keeping track of all of these different things and you'll need that kind of paperwork. These types of things come in handy because it helps you kind of stay organized. Anytime you itemize your deductions, they have to be on what's called the Schedule A of the 1040 form, and the 1040 is the form you use when you're filing taxes. And most people kind of have to do an either or. Either you decide to itemize or you use the standard deduction. And so when thinking about whether or not to itemize versus uses the standard deduction, it will probably come down to the type of paperwork of receipts that you think you have, and if you think you have more than the typical deduction. And so again, I think a lot of times this makes sense with small business owners, or if you have multiple businesses, things like that, where there are lots of different expenses from different places, and you would have a lot of business expense. It usually will be a good strategy to itemize. Another important term to come up here is tax advantaged or tax advantaged accounts. So it really refers to any investment account, savings plan that's exempt from taxes, defers taxes, or offers any other kind of benefits. And so there are a bunch of different regular accounts, which we're going to talk about, the different health and investment accounts. Those are tax advantage accounts. But then also, if you were in our previous sessions, we've talked about some of these other tools: municipal bonds, partnerships, UITs, and annuities. Those are other investments that would be considered tax advantaged as well. So it kind of covers the gamut of any of those things. But as I said, we're going to talk a lot about today the different types of health and retirement accounts here. So one of the first types of accounts is what is called an FSA, which is a health flexible spending arrangement. And it's important to know with these first two types that these are based on your employer. And it allows employees to be reimbursed for expenses. They're usually funded. It's an agreement with your employer. Usually they do take some sort of deduction from your paycheck. There aren't any taxes, employee or federal taxes, deducted from the contribution, and you don't need to put it on your tax return. And the employer, they might also contribute. So sometimes the employer might match, or they might say like, hey, we put $1,000 or whatever that number is. And so it really depends on what your employer offers. So why are these helpful? They can be excluded from your AGI, your adjusted gross income. You don't have to pay any taxes. Even if you get reimbursed, those also can be tax-free if you pay certain kinds of medical expenses. You can use it to pay medical expenses even if you haven't put money in the account. And for 2020, you can do a up to $2,750. But even if you don't use all that money, you can carry it over year to year. So again, this is only for people who get it through their employer. If you're self-employed, you're not eligible. So on the left-hand side, this is just a little graph. It kind of walks you through. The employer lets you enroll. You can decide how much money you're going to put in, and you kind of set up a schedule. You can go to your doctor or the pharmacy and show your card. What they'll do is they'll submit the services to the insurance, and then the doctor will either charge you a copay or they'll send a bill after the insurance is applied. And then the expenses can be reimbursed, or if the employee pays up front, or the employee is then responsible for that bill and you can pay it out of this account. So this also here is just like a quick example so you can understand like how this is helpful. Is if you make $35,000 and you estimate your healthcare expenses are going to be $2,500, if you don't have an FSA, you pay your taxes and then you would deduct that expense out of your kind of final take-home pay. But if you do have an FSA, what it does is it lets you reduce your adjusted gross pay. So in the first example, you're paying taxes on the full $35,000, but in the second example, you're paying taxes only on the $32,500. So your estimated tax rate could be the same, but just by the fact that that you're lowering your AGI. In this very small example, like you get to take home almost $700 more. So that's why these are valuable. If your employer offers it, it's just something really helpful for you to take advantage of. And again, if your employer puts money in it, then it's literally free money, because you get to keep the money in the account and can use it towards your expenses that you're going to pay anyway. Another account that is similar is called a health reimbursement arrangement. And again, it has to be funded by your employer. It can't be a salary reduction agreement like the previous one. So what it is it's a full reimbursement for medical expenses up to a certain amount in over the coverage period. And the thing about an HRA is that it can be offered with other health plans, including FSAs. So again, the contributions made by your employer can be excluded from your income. The reimbursements, again, can be tax-free if you pay certain types of medical expenses. Any amount you can carry forward to other years. And then there's no limit to the amount of money the employer can contribute. And so these graphics also are helpful to show. So in the first, on the right-hand side, you can see that step one is the employer decides how much you're going to put in. The employee goes to the doctor. They submit the bill to the insurance. The pharmacy or doctor charges you. Then they send the bill, and then the HRA will reimburse expenses, or the employee has to pay if there's some sort of limit. And there's a question here, and I'll address it. This is a good question. So it says, has this changed in recent years? And so Tammy, this is a great question. I think it depends. Some accounts are use it or lose it. This account is not, but some other accounts have previously been as if you didn't use all of the money, then you have to, then you just lose it. And I've heard of this too. I think it might be some of the dependent care accounts that are ones that you have to spend a certain amount of time, a certain amount. But here's the example. So in the middle, it says HSA, FSA, HRA. Can anyone use it? HSA only if you have a high deductible plan, and the FSA and the HRA is only if your employee offers it. Who contributes money to it? HSA is you do, but your employee can also. FSA, you do what your employee can, your employer can. And then HRA, only your employer does. And then this is the question that Tammy just asked. What happens money after the year is up? HSA, it stays in the account until you use it. FSA, you will lose it. And HRA is, it might roll over or you might lose it. So again, I think it depends on the type of account. Some you will lose it and some of them you won't. But with this HRA, it can stay. It's really up to your employer whether or not. But from the government standpoint, if they wanted to keep letting you roll over, then you could roll over. With the first two, HSA and FSA, you can't use it to pay your premiums, but with an HRA, you could. And then the last thing is kind of like, well, what's the point? The HSA is to save pre-tax dollars for any health expenses you know are coming up. Same thing with the FSA. And then for an HRA, it's really usually used where your employer is giving you the money to help pay for your with the insurance plan. And that's why you can use it towards your premiums. All right, we just talked a little bit about HSA. It's the health savings account. It's tax exempt account you set up to pay certain medical expenses. You have to be eligible. If you are HDHP, it means you have a high deductible health plan. If you have a high deductible health plan as your own person, you can only contribute up to $3,550. But if you have a family, you can contribute double that, $7,100. And so why would you get it? You get a tax deduction for contributions you make to your HSA, and you don't need to itemize. So this is a kind of one of those deductions you get to take anyway. Any contributions made to the HSA by your boss, the employer, also can be excluded from your income. It remains in the account. It's not a use it or lose it, unlike the FSA. And if you earn any interest or some of these you can do some limited investing. If you make any money on it, they're tax-free, and any distributions is tax-free. So if you're paying medical expenses. And an important thing to know about HSA, it's portable, so it stays with you even if you change employers or leave the workforce. So the first two, as we talked about, those ones are very specific to who your employer is, but with an HSA, it isn't tied to the employer. So that doesn't mean your employer can put money in it, but if you happen to leave or go to a different company, you still would get the funds. And so that being said, there are some qualifications. You need to have a high deductible health plan. You can't have any other health coverage except what is permitted. You can't have Medicare, and you can't be a dependent. So what happens with this is similar steps. You go to the doctor, you show your insurance card, the doctor submits services to the insurance company, and then the doctor will send you the bill after the discount. So these are just important things to know about an HSA. They're a good tool to have because, again, it's tax exempt, and you can include it as a deduction. Another important account is the medical savings account. And so it's another tax exempt trust or account that you set up, but you can set it up with a financial institution, a bank, or an insurance company. They usually offer it. And it's a way for you to save money that you know you're going to need for medical expenses. These were initially kind of created for people who were self-employed and or not just self-employed, also people who have like a small employer, and they also want to save up for these types of accounts where, I guess the reason why is, as we mentioned, some of those other accounts, they're only open to people through their employer. So this is an option for you if your employer doesn't offer it. You can kind of set up your own savings account. And if you're self-employed, or if your small employer kind of helps you or allows you to set it up. So what that means is if you have a high deductible health plan, you or your employer can contribute up to 75% of the annual deductible. So an example is like, I know in my health plan, my annual deductible is $1,750. But in this example, if it's $1,750 for me, and for a family it is $3,500, then that means I could contribute up to $2,625 to this account for my medical expenses. And then if you're just by yourself, that means that you could contribute up to $1,113.75. So $1,137.50. So this just, again, it's an important tool to have if, you know, maybe your employer doesn't offer anything else. It's still a good way for you to kind of sock money away and then still be able to maintain the tax benefits, because you can, similar to the previous one, we were talking about the HSA, you can claim this as a deduction. Even if you don't itemize, but either or, and it's on the Schedule A form, whether you're 1040, any earnings or interest similar to the previous account, they're tax-free. Distributions can be tax-free if you're paying qualified medical expenses. This is another one that's not use it or lose it. It remains in your account until you use them. And it's also portable, so you can keep it if you go to a different employer or you leave the workforce. So that being said, the qualifications are you have to be an employee of a small employer that maintains your health plan, or you're a self-employed person or spouse of a self-employed person who has this type of HDHP, so that type of healthcare plan. All right. We have another question. Can it be used to pay the health premiums? It cannot be used to pay the premiums, but it can be used to pay the health expenses. So that was a good question. The only account that lets you pay the premiums is the HRA, the reimbursement account. And that's really because your employer is the one putting the money into the account, and then that money can be used towards your premium. So it's almost like they're putting the money in there so you can use it to pay for the insurance. The other accounts, it's really just for the actual health expenses themselves. All right. So those are all the major health accounts that we have that we're covering today, the health savings accounts, but there are other accounts that also can definitely help you reduce your tax burden. And so there's kind of two categories. There's employer-sponsored plans, which we're going to talk about 401k, 403b, pension plans, ESOPs. And then there are the second categories, which are self-directed plans, which just means that they're not tied to an employer. And important to note that most of the first group are what is known as tax deferred. And then the other ones are usually tax exempt, so pre-tax versus post-tax. But we'll talk a little bit about that in a second. So a defined benefit plan, what it is it promises you a specified monthly benefit at retirement. It can be a fixed dollar amount, or it can depend on a formula. There are defined benefit plans are usually known as pensions. These have kind of come out of favor in the last few years. They're not as popular as they used to be. Employers will sponsor, they'll either sponsor the defined benefit plan, or they'll hire an investment manager and to choose the investment choices. And the employer shoulders the investment risk. So this is part of why this has fallen out of favor. What we've kind of found over the last couple decades is that the risk has really increased, but the pension obligations have stayed the same. And so a lot of employers have found that it hasn't been as advantageous for them as they thought it would be. So because it's defining the benefit and not the contribution part, that's where it's tough, because if they don't make the investments to meet the benefit they're promising you, they're kind of on the hook to figure that out. Whereas obviously the employer would probably prefer that you figure that out, which is why kind of as a consequence, defined contribution plans have become much more popular. And an example of one of these is like a 401k. It doesn't promise you a certain kind of payment, but you and your employer both will contribute to your to this account under whatever the plan is. It might be a set rate, it might be a certain percent of your salary. But the difference here is, of course, that the employee shoulders the investment risk, and the account can fluctuate depending on the investments. So when you retire, you'll receive whatever's left, which depends on how much you've been putting in, and then any investment gains or losses. So why this is important is, if you think about, sometimes where things have been tough with the market. I know the last year and a half, the market's been fluctuating a lot. After the kind of financial crisis, 2007, 2008, a lot of defined contribution plans lost a lot of value. A lot of people, if they were retiring right at that time, it was not great for them, because the market it was very volatile. So that's why it's much more risky for you as the employee as opposed to the employer. So on the right hand side, I just have this graphic talking about taxes in retirement, like what are the main factors. So one that's up there is Social Security. You usually have to pay taxes on a certain percentage of your benefit, and the tax rate could be anywhere from 15 to up to 45%. And then for your IRA and 401k, if you make any withdrawals, those are usually taxed. And then if you get any investment income, you have to report it on your 1099 tax form. If you have an annuity, it depends. Those are some of the tax advantaged accounts we talked about, but some aren't, so it really depends. And then if you have a pension, again, if you get that, most of the income on that will also be taxable. So those ones that we just talked about, those are all employer sponsored. These are all self-directed plans. So it's kind of like you're at your own mercy. So you can create at any time an IRA, an individual retirement account, and provides you those tax advantages. And you can contribute each year the maximum amount allowed. I want to say for 2020, I'll confirm the IRA tax limits. If you're under 50, it's 6,000. If you're 50 or older, it's 7,000. So that's your Roth IRA contribution limits. And then if you have a traditional IRA, there's no age limit to contribute. That's new for 2020 because the Secure Act removed the age limit when someone can contribute to an IRA. The top age before used to be 70 and a half. So that's just important, again, something important to know, because when we talk about the different IRAs, it says traditional IRA contributions are tax deductible. You don't pay any taxes on the earnings until retirement when they're taxed as income. But again, there's now no age limit in which you can contribute to an IRA. So that's new. With the Roth IRA, the contributions are made after tax and they're not tax deductible, but the earnings and withdrawals are tax-free. So what this means is if you are a savvy investor, you could earn a lot in your Roth IRA and then your withdrawal would be tax-free. So in SEP IRA, which is for a self-employed person or a small business, kind of what we talked about a little earlier with the savings account, the health savings account. This is similar, where this is a way for you to create your own retirement plan, which is similar to a traditional IRA, which means that the contributions are tax deductible, but you don't pay any taxes on any earnings until retirement. There's also something called a simple IRA, which is made for small businesses who don't have any sort of retirement plan, and it stands for Savings Incentive Match Plan for Employees. It allows the employee to contribute similar to 401k, but it's usually cheaper and the contribution limits are lower. So as I said, the contribution limits for Roth IRAs were 6,000, 7,000. For 401k, let me confirm what the contribution limits were. Yeah, so for a 401k, the limit increased to 19,500, and the catch-up amount, and this is for 401k, is now $6,500. So what that means is those used to be $19,000. This year for 2020, it's $19,500. The catch-up contribution used to be $6,000, now it's $6,500. This is for 2020. For the simple IRA plan, it is $13,500. And again, this information is straight from the IRS. So just important info to note. All right, and moving on to the next section, tax credit and tax deduction. So what's a tax credit versus a tax deduction? Tax credit really is just a straight dollar for dollar reduction in your tax bill, whereas that's what a tax credit is, and a deduction is just where, as I said, it lowers how much your income get taxed. So a tax credit, what they call it here, it's found money, because if it reduces your tax bill to less than zero, the IRS potentially can refund some or all of the money back to you, depending on what the credit is. And then tax deductions, again, they reduce your income, and those usually fall into three categories: standard, itemized, and above the line deductions. So some important tax credits. Yeah, you can go to the next slide. There's educational and the earned income tax credit. So educational, there's actually two. There's the opportunity tax credit that can be claimed for the first 4 years of college, and it provides a maximum of $2,500 per student per year. But then there's something called the lifetime learning credit, which is up to $2,000 per year, and it helps adults pay for college and educational expenses that are going to improve your job skills. So this could be, even if you've gone to college, maybe you decide you want to do a master's degree, or you do some sort of, certification program, something like that. Those types of programs are eligible, and you can get that credit of $2,000 per year. And so again, this is $2,000 just off your tax bill for that, because these are tax credits. Another important one is the earned income tax credit. And this is calculated based on a formula, depends on your family size. It can limit from, almost 16,000 for a single taxpayer to a family who has 3 or more kids up to almost 60,000. And depending on a bunch of these factors, income, marital status, and your children, you could get this tax credit for up to almost 7,000 in 2020. So again, just important to note, these tax credits come like right off your tax bill. And then this table here shows you all of the standard deductions if, depending on your filing status. If you're 65 plus or you are blind, you get an additional amount of money. So again, this is the standard deduction. If maybe you just don't have the info, you aren't tracking as much, you're not going to itemize, then that would be what you use. If you're itemizing, there's a bunch of deductions here. One is the charitable contribution deduction. They're deductible even if it's not, and it doesn't have to be cash. So it's important to note, especially on Nantucket, a ton of people are always donating stuff. If you donate any sort of gear, food, household items, those can also count towards your tax bill if you go to a real charity and you get a receipt. And most charities have this process kind of like down pat. And so you can easily get a receipt for donating. Another important deduction is if you have a home, you can get a home interest deduction. So you can itemize if you deduct the interest on the purchase, if you make a building or you do some sort of improvement. And for loans that were originated after the end of 2017, you can deduct home mortgage interest up to your first 750,000. Or if your loan was before late December 2017, you can use the maximum of 1 million. So again, home mortgage interest, this definitely adds up, so it's worth doing if you are itemizing your deductions. Another important deduction is the private mortgage PMI premium deduction. So if you have less than 20% equity in your house, you probably have to pay PMI. It's required by anyone who gives you a loan, and it's to protect them if you stop making payments. So this PMI deduction had been eliminated previously, but it was reinstated at the end of 2019, so it's available for 2020. So again, this is one that you might not know about because it was, and then it was gone, and now it's back. So just important to keep in mind. Another set of itemized deductions are medical expenses, as we talked about. You can take all the medical expenses we talked about, but also in general, if there's a large medical expense, it's more than 7.5% of your AGI, adjusted gross income, you can take that. And also depending on your state, but usually you can deduct the taxes you had to pay in the same year. So it's like if you have to pay state taxes or personal property, if you had to pay sales tax, some of those other things, you can also deduct those taxes. So just important again to note. So if you maybe made some sort of large purchases and you had to pay a sales tax, or again, personal property, those types of things, just important to note you can deduct them. And then the last kind of deduction we're going to talk about is above the line deductions. And what it means is they're subtracted to arrive at your adjusted gross income. So even though it's similar in concept to itemized deductions, you don't need to itemize to take these above the line deductions, even if you take this standard deduction. So this little graphic here has a bunch of couple of them, like educator expenses, business expenses, your moving expenses, health savings account, self-employed expenses. If you withdraw any savings early, if you have to pay alimony, IRA, or student loan interest, those are all things that could be considered above the line. So talk a little bit about that. So alimony, if you got divorced prior to December 31st, 2018, and you're paying alimony, you can deduct that. If you're an educator, a lot of teachers I know do this. They have to buy supplies, books, computers, things like that. You can deduct up to $250 or $500 if you're married filing jointly of any of those expenses. Also, the HSA, as I mentioned, your contributions are limited to $3,550 or $7,100 or $1,000 more if you're 55 plus, but you can take these above the line if your employer doesn't already take it out of your paycheck. With IRA, similar, if you make deductible traditional IRA contributions, again, you can deduct up to $6,000 and $6,000 for a spouse, but this has to be, again, traditional IRA and not a Roth IRA. There's student loan interest. Those who earn below a certain amount of money, you can deduct up to $2,500 in student loan interest. And then there's another one that's new here, charitable contributions. This is new for 2020. You can deduct charitable contributions of up to $300. And even if you don't itemize, where normally you would only be able to do that if you itemize, for 2020, you're going to be able to take this one no matter what. And if you want to go to the, yeah. So these ones I put in a whole category, self-employment deductions. Note, keep great records, but there are a couple of really good ones in here. If you're self-employed, you have to pay this tax. It's 15.3%. Everybody has to pay that, even if you're a company, but normally the company and the employee share that expense. But if you're self-employed, you obviously have to pay that whole expense yourself. So the government lets you deduct half of the amount from your taxes. And again, you don't need to itemize to claim this. This is a good one where you're paying this tax anyway. You should be taking half of it off, no matter what. You also can deduct for home office. And there's a simplified or the regular method to reduce it. Like if a portion of the home is used as dedicated office space. And so what it means is, like, if 1/5 of that space is used as office space, and you can use that kind of proportional deduction. Also, if you're self-employed and you pay your own, your own insurances for health, dental, or long-term care, those premiums are deductible, as well as contributions to, if you have a self-employed retirement plan, an SEP, those are also tax deductible. And another one here that is, and again, we're going to talk a lot more about this next week when we dive into details on small businesses and being self-employed, but business travel expenses obviously tax deductible, but if you combine a vacation with the business trip, you can reduce your vacation costs because you can deduct a percentage of the expenses for business purposes. And it can include airfare or your hotel proportional to the amount of time you spend on it. And there are a bunch of other business deductions that, business mileage, shipping, advertising, website fees. If you have internet in your home, you can deduct that. Any publications, memberships, travel, office supplies, or any of those expenses that you incur to run, gas, things like that, those can all be deducted on from your tax bill. So very important to kind of keep in mind. There's a lot of different types of expenses. If you're spending money on it and it's for your business, you can deduct it. And I want to say here, there are three kind of main big new deductions for 2020. As I mentioned, the $300 charitable contribution deduction applies to any cash donations made before December 31st. The charitable deduction limits based on adjusted gross income, it used to be 60% was the limit of your AGI. So if you made $100,000 a year, you could only donate $60,000. That is now 100%. So that's gone up. So if you make a large donation, you will be able to deduct the full amount. And also for IRA contributions for older workers, as we talked about, you don't need to be 70 and a half anymore to take the deduction for the contributions. You just need the earned income to make the contributions. But this is a change where you used to have that 70 and a half kind of requirement. And then I note at the bottom again, keep all receipts on all medical expenses and any other expenses that are more than $250. And that's it. These are a bunch of the sources. So if you want to look up any of this stuff or you want to know more, there's a lot of good sources here. And that was kind of everything I had today. I don't know, does anybody have any questions?
You can go ahead and unmute yourself if you have a question, or you can put it in the chat.
Or if not, as I said, yes, this is recorded, Sarah. Good question. We did record this session.
Hey, Abby, I got a question.
Sure.
I do my taxes electronically. Is
Mhm.
there pros and cons to that? Am I totally missing out on deductions and things I could be looking for? Or do you find those platforms to be pretty good as far as making sure you cover all your ins and outs?
So you mean like TurboTax and
Yeah,
those types of guys?
TurboTax, Slayer. I know H&R is kind of starting to break into that market, especially with COVID. They kind of made that transition.
So I would say usually they're really good. What's really good about the electronic ones is when the laws change from year to year, sometimes you wouldn't necessarily know. Like, for instance, we talked about like this charitable contribution thing.
Hmm.
I think people, if they're just doing their taxes themselves, like paper, you might miss that. So that's where a lot of those platforms are great, because they are always really up to date with knowing the things that have changed. I think where sometimes it just might be helpful not to necessarily not use it, but then to double check is if you do have itemized deductions or you have like a more complicated tax situation, it is probably worth talking to a tax professional, because I think those like programs are good if your taxes are relatively simplistic, but I think as things get more complicated, that's where you might be missing out. I would say if you're self-employed or you like have multiple businesses, or it's just like things are really complicated, I would think you might just have an opportunity. If you talk with someone, they might be like, oh yeah, this might be something important to think about. But if your taxes are pretty basic, I think that they are good for you to use. And the advantages of filing electronically is it's cheaper. It's easy. You usually get your money faster if you're expecting a refund. Like, those are some of the benefits. Also, if you use the same platform year over year, it saves your information, which is really helpful. Like, so then it's less time intensive.
Okay. I know you went into some of the processes that go into receiving your tax benefit via donation to a charitable corporation. And if I'm going to step on the 3rd edition next week, just tell me, how much of a tax benefit is that? How much can people, what does that look like, and what can they realistically expect? From my understanding, it's hypothetical. You owe 800 in taxes. You turn around and donate 400 to an organization. Would you then just owe 400 back in taxes? Do you just get to subtract the 400 from the 8?
It doesn't work that way. The only thing that works that way is the tax credits, where it will literally reduce your tax bill dollar by dollar,
Right.
but it will reduce it by some factor. So
Right.
it wouldn't be if you owed $800 and then you made a $400 charitable contribution, then it wouldn't like reduce your tax bill by $400. But what I would say is, if your goal is in this scenario that, let's say you owe $800 and you want to reduce that, what would probably be a better use of your money would be if you did some sort of additional contribution to like one of your tax deferred accounts. Because especially like if you had a health savings account and you can roll that money over, what you could do is put making up a number, maybe you put $400 additional into that account, it will lower your taxable income. So then the number that you were going to owe will naturally go down. But then the better part is, but you're going to be able to use that money later, but you don't have to use it at like X time.
Right.
So, so it's, and theoretically, if you put $400 in like a health savings account,
Mhm.
and it's an investment, that money can grow over time. So it would really be more of like a long-term benefit for you to do one of those types of contributions if your goal is to be lowering the amount of money you owe in taxes. But but that being said, though, if it is worthy to look between, like, if you're saying standard deduction versus itemized, because if the standard deduction is for a single person, it's 12,000, etc., but that like you donated $20,000 to charities, then it definitely is worth you doing the itemized deduction versus the standard deduction. And also, what's important to keep in mind is there are a lot of deductions that you can do with both. So there are deductions like the above the lines when we talked about, those educator expenses, the alimony, those things. Even if you don't itemize, you can still take those deductions. So I think it's really important to just like look through and make sure to track that, like, there might be an opportunity for you to lower your tax bill that way.
Okay.
So it wouldn't just be the charitable part, but I think all of those different pieces.
Right, because under the previous administration, that charitable tax benefit was changed, right?
Right. It was changed. It's now less restrictive. And again, new for this year is that additional $300 deduction that anybody can take. So
Okay.
before, what happened with charitable expenses is if you weren't itemizing, you usually could not take your charitable deductions because you were not itemizing. But now you're going to be able to, if you don't want to itemize for whatever reason, okay, but you can still get at least $300 in charitable. So that is new for this year.
Okay.
So
how new? I'm sorry. How new is that?
no, it's new for this year. It's never been.
Oh, okay.
So it's not one of these old ones. A couple of the ones I mentioned, like the previous one with the tax, the PMI, like those ones that we used to have them, they went away, they came back. There's a couple of deductions and things like that went away and came back, but this charitable tax one is completely new. So it's never been kind of both of, you can standard deduction and take some money on charitable contributions. It's always been kind of either or.
Okay. Would you say this new has increased the incentive for people to pursue that route in terms of a giving or a benefit?
So if I were to guess the rationale behind it, I would think that it was to incent people to donate to certain kinds of charitable organizations because they would be able to take the tax benefit on it. So I think people who were doing, like, people have always been doing certain kinds of deductions. I just think now it's more accessible to people who maybe, I think who was missing out before is maybe people who, if you're not going to be able to, because the standard deduction is fairly high. So if you're not going to donate more than $15,000 to a organization and get any tax benefit, it's a lot harder for you. But at least now, even if you say, well, I'm going to do $500, like my employer matches a $500 donation. So I think it does kind of incent maybe a certain portion of the population that wouldn't have had access to that kind of tax benefit before.
Okay.
Because $300 it's not a huge amount, but it's really nice to know if you gave 300, 250, that you can, get that money back.
Okay. Good to know. All right, are there any other questions? We got two still hanging with us. Stacy or Tammy, any questions? If not, we will let Abby enjoy the rest of her night and we'll close this out.
Yeah, we'll see you guys later. Thank you for attending.
Thanks, Abby.
Bye, guys.
Bye.